Mark, good morning.
Hey, Jeff.
How are you?
Good. Nice to see you again.
Good to see you.
Virtually.
Good to see you in the office.
Somebody's got to be here.
Well, hey, we've only got about 30 minutes, but I thought you and I have known each other forever, but I thought it'd be fun for you just to share with folks a little bit of your background because you've been doing what you do for a while. We'll start there and then I'll jump in with some other questions.
Jeff, here's the tagline. I'm the oldest and longest lasting internet analyst on Wall Street. I tell that every time I go into Starbucks. I've not yet gotten a discount, but it's true. I started in 98 working with legendary analyst Mary Meeker and been covering the first Friday I was on the street. I got a call from this CFO of this small little online auction company that was thinking about going into the public markets. Its name was eBay, and the rest is somewhat history. So I've been lucky. I've been able to track Google, Amazon almost since the beginning, Google since its beginning, Facebook, Twitter, Uber. So I look at a lot of consumer internet names, and I've been lucky. I enjoy my job.
What maybe on that note, when you think about the compounding knowledge that you've built up over a long period of time, I mean, I tell people that one of the fun things for me about my job today is, I've spent 25 years in Silicon Valley, and I feel like there's a lot of things I've learned along the way that I can actually apply to my day-to-day job. And, in particular for me, as an example, when COVID hit and the market cratered, I went in the market and bought a bunch because I was like, I was here for 9/11 and I was here for 08, 09, and the market bounces back. I didn't know when it would bounce back, but I had that knowledge and experience to know that it would bounce back. What are some of the things that you kind of think about that come to mind that are, gosh, these are things that I've just learned over time and have enabled me to really have conviction? Because one of the things I love when you're on CNBC is you have really strong conviction about names when other people are scared. So share a couple of lessons you've learned over 2 decades.
Yeah, well, I think, Jeff, I take your same lesson, but I just apply it to stocks. So I've used this concept called DHQ, not DQ, that's Dairy Queen, but DHQ, dislocated high quality names. And if you can spend, in my job, trying to pick winners and losers, trying to, find the stocks that are going to most outperform, I really am. I guess if I were to, fundamentals matter. I've done this long enough. Strengthening fundamentals almost always lead to stock prices going up. Now, it may not be perfect, and it depends on the valuation setups, but the market does long-term reward fundamentals and improving fundamentals. And so I guess maybe that's the one thing I've got drilled in. But secondly is there's always going to be dislocations in stocks. And that's certainly the case with poor performing companies, but it's also the case with the best performing companies. You can pick the best stocks and they will all have had, even in the last 2 or 3 years, some of the best names I look at, the Facebooks, of course, but Amazon, Google, Netflix, other names like that, they've all been dislocated at times, whether that's company specific or it's market specific. And, stocks always, it's a mixture of those that really drive stock performance near term. So if you really want alpha performance, you're doing it on the broad market basis. I do it on a company specific basis. I try to identify the high quality companies and just wait, because in order to buy or to add to positions or to get super bulled up on it, it's when there's dislocated, because I know they're going to be dislocated. I guess that's the other lesson I've learned. It's markets follow fundamentals. There are long term. There's plenty of dislocations near term. If you really want to make good money, identify the highest quality companies. Hopefully, get that right, and then wait for those dislocations because they're going to come.
Yeah, it's such a great, and be patient, right? I mean, I think that's the other thing is people always ask me, what should I buy right now? And I'm like, well, I'm not buying anything right now, but I am waiting for those little dislocations where there's a little blip in the market, and a company that I love, I'll just add more. And I'm not really a seller. I'm not a trader. I'm somebody that buys and owns great high quality names. I've owned Salesforce since it went public. Probably could have switched that into some other higher performing assets, but it's a great high quality company I love owning. What maybe for folks that don't totally understand what you do, could you just explain what the role of an analyst is, and let's just start there.
Yeah, and sometimes I try to figure out what I'm actually doing. I get it. I get the question. Look, I'm an equities analyst on the sell side. So I worked at a couple of different banks along the way: Morgan Stanley, Citibank, Royal Bank of Canada. Now I'm at EvercoreISI. And my job is to cover, I just focus on consumer tech, really consumer internet stocks. It's about 40, 50 names that I've tracked over time. And my job is essentially to make calls on them, to figure out whether they're buys or sells, what they're worth. My clients are institutional investors, which could include large and small hedge funds, long only mutual funds, can include pensions. And yeah, there are literally hundreds, thousands of firms around the world that need to make investment decisions, and then need to decide what part of that portfolio is in equities, what part of that portfolio should be in high growth stocks, and within that, what part should be in consumer internet. It just so happens by skill or by luck that I cover three of the largest market cap names in history and in the world. And so there's just, if you're running a portfolio, whether it's for retirees, whether it's for high net worth individuals, whether it's for a large number of retail investors, you probably have to make a decision along the way as to whether I should be overweight or underweight in Amazon, overweight or underweight at Google, and that's where I come in.
And so when you say cover, if I were to think about your job, it's a combination of understanding the markets they play in, analyzing the financial performance of the company and trying to make some forecasts as to what they might do in the future, and then also evaluating the quality of the management teams and the leadership. Are those kind of the three basic pillars? There's something else that I'm...
No, I think you probably got it right. I focus on, real simply, I focus on what the market opportunity is, what the business model looks like for this particular company, and how competitively well positioned are they against that market opportunity. I may have screwed up the order there, but market, competitive position, business model. Those are kind of the three things. And there's so many factors that go into determining that. But and that's that's one of the things I tried to wrap up into a book I recently published, or I'm in the process of publishing.
Well, let's talk about that. Let's talk about the book. Tell us a little bit. How did you come to write a book, and what's the intent?
Well, you may have seen me actually do a first crack at the book. I gave a talk at the Fortune conference in Aspen a couple of years ago, and I was given 10 minutes to talk about 10 lessons from investing in tech stocks.
Yep, I was there.
And I've been thinking about writing a book. As a sell-side analyst, I write a lot. That's kind of my day job. And I'm essentially a reporter, but hopefully more than that, an analyst and trying to predict the future. I'm as good as that as anybody else, which is, there's always a lot of caveats there. But anyway, it's something I really want. I've lived through something that's really fascinating, the rise of the internet over the last 25 years. I mean, the rise of the commercial internet. I mean, the rise of the public market internet over the last 25 years. And I just thought there were some fascinating lessons in there, both from the big wins and from the big blow-ups and the losses and the kind of middling performances. There was a wonderful book written 40 years ago that you and I may remember, Peter Lynch's One Up on Wall Street.
I've read all his books.
Yeah, great investment advice for professional investors, retail investors across the board about how to invest. And I really wanted to write kind of an update of that. Instead of talking about Pep Boys and Dunkin' Donuts, I wanted to use commonplace names that people understood: Amazon, Netflix, and other names. And so I tried to go through that and figure out what caused some stocks to do phenomenally well, because that sector returned some stocks. Amazon's up 167,000% since its IPO, and Netflix up 46,000% since its IPO. There's got to be lessons from that. But at the same time, there's got to be lessons from what happened to Yahoo, what happened to eBay, why did DoorDash win and Grubhub lose? Yep. So I tried to call all of that into 10 lessons that hopefully are helpful, and I think they are, for any investor that's looking at them. I also wanted to give people two basic points, which is, you mentioned this earlier, don't trade, invest. You can make really good money investing in high quality, high growth names, not irregardless of valuation, but with valuation not being the primary criteria. You really want to focus on the fundamentals first. So I try to get that point across. Don't trade, invest, and then how to find those high quality names, and then how to discover dislocation opportunities.
And so is the book intended for folks who are just starting out as investors, people who are professional money managers? Who do you think of as the audience?
It's probably more the first rather than the second.
Yeah,
There'll be stories in there that any professional money manager, because I pull up and I explain why it is that Spotify beat Pandora, why Amazon beat eBay, why, from my perspective, why DoorDash beat Grubhub, and what are the lessons. There are also some lessons in there for companies too, because I go down as one of the top tech analysts on the street. I think the subtitle of the book is from one of Wall Street's top tech analysts. I didn't come up with that. That was my publisher. I'll still take the title.
I would have given you that title too.
Thanks, Jeff. But if you're a management team and you're thinking about entering the public markets,
yeah,
I've got some. I'll tell you how. This is how I'm. That train is too strong of a word. This is how I'm encouraging investors to think about growth stocks and tech stocks. So if you're a management team of one of those companies, you may want to know what investors are going to be encouraged to look at.
Yeah, and it's funny. I probably read Peter Lynch's books. I mean, I don't know how long ago they came out, but certainly right after I was out of college, and just starting to think about investing. And they were just so really, for me, they were easy to understand. Right, walk down the street, look at businesses you know and love and are doing well, and own the equity. And
Yeah.
I owned Starbucks. I owned Alaska Airlines. I owned a bunch of things. I grew up in Seattle that you could just tell we're doing well and a good. I didn't own a lot of shares because I was young, but I think that advice is so, it's like when people ask me, I just, got $100,000 bonus. What should I do? My answer to them is like, well, I personally have some categories that I love, like cloud computing, like digital payments, like, the shift to kind of low code, no code. And I'm betting on companies in those spaces, but I'm not really trading them. I'm just accumulating more over time. And at the end of that, 5, 10, 15-year window, I think they'll be more valuable. Because I look at Netflix, I look at Amazon, I looked at Google. I wish I would have owned more of all of those. But I think the trick is really picking like you mentioned, there were a bunch of counterexamples where they didn't go as well. What's kind of the big, takeaway? Is there a common thread between those examples where you have like one moonshot and one that kind of was an okay outcome, but maybe not a great outcome? Because I think from the outside, we see it at a very visceral level. Oftentimes we're investors in those companies when they're private. You mentioned Pandora and Spotify. We were in Pandora. And, so we're often on the boards, we see the management teams, we see the inner workings, but to the average person buying the stock in the public market, they may not have access to the team. How do you, A, what's the common thread? And B, how can people who are investing in the market kind of figure out those things like you're seeing them, see the difference between the A and the B?
Okay, so I try to go through these case studies in the book, but I really try to make it as common sense and as approachable as possible. And again, my big push, if you're going to remember one thing from the book, it's DHQs, dislocated high quality companies. So I have a chapter on each of the 4 factors that I think determine what a high quality company is. One of them is obviously management. Now that's very hard to do from like a retail investor perspective, but you want founder-led companies. I mean, if you look at the wealth creation, that's very heavily skewed towards founder-led companies for a variety of reasons. I even pull up examples like Zillow. Founder-led companies oftentimes can make really aggressive bets when they're required or when there's an opportunity. Professionally run companies aren't necessarily that aggressive. eBay and Amazon may be a classic example of this. Amazon way back willing to bet aggressively on this Prime program, even though it was going to trash the stock and trash earnings near term. But Bezos was committed to this, realized it could be a really successful customer loyalty program. And eBay just never innovated and never thought about vertically integrating and figuring out whether they needed to ever build out distribution centers. They weren't really willing to take big risks. So management team is one. Customer value prop is super important, and that's also a big difference between Amazon and eBay. One company was run. The expression I use is follow the value prop, not the business model, or follow the value prop, not the money. The companies with a better business model don't always win versus the companies with the better consumer value proposition. In fact, the latter usually win. Grubhub and DoorDash are a wonderful example of this. DoorDash has a much lower margin business, much tougher to scale up. But where are they now? DoorDash has got 20 times the market cap that Grubhub had when it was taken out. And Grubhub's last words, they always talked about how good their business model was, but it wasn't. They didn't have the value proposition that consumers wanted. They didn't have the restaurant selection because they were trying to defend those margins. So that's the second thing. I look for companies that are really good at that really focus on optimize for customers, don't optimize for investors. And you can see that in kind of the way they talk about their business. Third is I look for companies with really large market opportunities. It's a real simple point, but the bigger the TAM, the total addressable market, the greater the chance for premium growth. And premium growth, 20% plus revenue growth is rare for scaled businesses, the S&P 500 businesses. It's really rare. And when people find it, it's very valuable. One of the ways you can increase your odds of having premium revenue growth is to attack large TAMs. Google is a wonderful example of this. Google did 20% growth for 10 years after hitting a 25 billion revenue run rate. 3 companies in history have done that: Apple, Amazon, Google. And they did it because they were attacking a TAM, $1 trillion TAM, and they had a single-digit percentage share of it. So you want to, I call it pulling a Google. You're not going to, it's going to be another company once a decade that'll be able to really pull a Google like that. But companies that can do it off, generate premium growth off of 20% revenue growth rates, that's what I kind of look for. It's a good tell. And anyway, that's I think I clicked them off again. Management team, value
Yeah.
positions, TAMs, and yeah, and then that 20% revenue
The
growth.
TAM story is such a great one. I think, I'm in the tech industry, you're in the tech industry. So we see these markets, right? I think a lot of people externally don't really comprehend how big they are. And I remember when we were an early investor in Square, and Jack Dorsey came in to pitch our partnership. And one of my partners asked, he said, Jack, you're replacing point of sale. That market isn't that big. And Jack looked at us and he said, I'm replacing cash. That was it. And you could have heard a pin drop and everybody went, that's a big market. So I think that what's so cool is the founders, and I would also add like a Jeff Lawson at Twilio, the founders who go in and create these public companies, and then they keep expanding the TAM, right? And I think a lot of times I've often tweeted out, there was an analyst who, when Salesforce went public, said that the TAM for CRM was 10 billion, the entire market. And of course, Salesforce today does over 10 billion a year in sales. So that market just got much, much bigger than I think people realized. And I remember way back in the day, I bought Netflix after seeing you on CNBC talking about it at around $100 a share. And you had a very simple, at least for me, it was a very simple analysis. Great management team. Subscriber base is small relative to the total global population of people who will potentially subscribe to Netflix. And they're investing aggressively in content, more aggressively than the legacy players are. And I thought, I need to own that stock. And it's been a great one.
You nailed it. And by the way, that also, there's two things about Netflix I found particularly interesting. I dive into a little bit in the book. One is management vision. This is a stupid example, but it's dead on accurate. So Netflix was founded in 1997 near us here, and it was called Netflix when you couldn't stream any video.
Right. There was no, yeah.
Yeah, it was taking you 4 hours to download the first, 5 minutes of Terminator 2.
Yeah.
But the name, it was they clearly had the intention of doing it. And then 10 years later, when we all had broadband, when broadband was actually available to most consumer markets in most households in the U.S., then it rolled out. But I look at that as it's a management tell. That was just an amazing industry vision. So Reed Hastings, huge check mark for that. But the other side is, and it's a point you made earlier, Jeff, I really like this. The Peter Lynch point was, you like the coffee, buy the stock. Like if you get to understand the product, we're all consumers here. If there's major innovation in consumer tech, well, you go ahead and try out the iPhone yourself or drive a Tesla and see if you think it's really interesting. You could have done the same thing with Netflix. And it's, you're sitting there and you're streaming anything you want, almost anything you want at whatever time you want on whatever device. Like that value prop is extraordinarily strong. And you don't need to be a genius to figure it out. Just pay $9.95 a month and you can do your own research on it. And I think people can do that more often than they realize. If it's a consumer tech name that you're really enthusiastic about it, that's one I tell my son, who just asked me about a high school project, and he wanted to think about a stock. And I said, well, what stock do you use? What company do you use that you really like? And he said, well, DoorDash. I said, well, dig into that one, something that you're really interested in, because if you are, there's a chance other people are too, and then figure out whether it's a good business model, management team's good, et cetera, et cetera.
Yeah. My kids, my oldest daughter has a job, and as she's been working, she's been taking the money she's earned and investing it. And she owns Shake Shack. She owns Snapchat. She owns Zoom. She owns Amazon. So she's doing exactly what you talked about. It's the Peter Lynch model. What about, we've been in this euphoric kind of 10, 11 year bull market with a blip last year. And one of the questions I get from a lot of folks is, how long can it continue? How far can these tech companies keep growing, and can they keep up these growth rates? And, when does demand slow down, and are multiples crazy? How do you, I have my own thoughts there, but I'd love to hear your thoughts. Just, we've been in this incredible 10-year boom of cloud computing and mobile. Now we're potentially getting into this new area with creator economy and metaverse and crypto. What do you tell folks on the buy side who are asking you? I guess it's sort of two questions: one, valuations, and two, does the tech market have another 5-10 years of exceptional growth, or are we sort of hitting the top?
Well, let me do three points. One is in the equity markets, we've had a phenomenal run really since the housing crash in 2007, 2008, the great financial crisis. Nothing like a crash to set up a bull market. So
right.
That's also, that's also why I start the book with like 3 warnings about, how you're going to lose money. Even if you buy the best stocks, they're going to be volatile and you'll make money, because sometimes you're not going to get you're going to have mistakes like I've made. Blue Apron was one of mine, admit it up front. And then I go through a couple of other mistakes I made in the book and try the
I
lessons.
can't wait to read this. This is going to speak to me. This is what I watch every day on CNBC. I can't wait to read it. Great.
Yeah, I mean, I had a sell on Google at the IPO, and then Jim Cramer brought me on his show and accused me of having a 3-egg omelet on my face, and he was right. And he still endorsed the book. There you go.
That's good.
So there is redemption. So anyway, I just want to warn people. We've had a long bull market. So part of the answer to your question is, well, how long is this? How much longer can this last for? Well, interest rates generally are relatively low, and one of the wonderful things about tech stocks is that if you have high growth is a scarcity in a world of limited growth. And the fact is, we generally have had pretty limited growth. That's why 20% revenue growth for a tech, at scale, and even higher, obviously, for many other companies. That's why it's so darn impressive, because GDP worldwide is 2, 3, 4%. So you're telling me you can find a company that can grow 10 times that? You bet that's worth a premium multiple, and it's probably one I should stick with. And then just in terms of these major tech platforms, their valuations, I think generally valuations amongst the largest tech platforms, I think, are pretty reasonable. You can, over time, as you well know, you go from price to sales multiples to cash flow multiples, and that can lead to a little bit of transition in the stocks. But you can buy some of these major platforms at PEs that range from 20 to 35. And I'm referring to Facebook, Google, Amazon at the high end of that, Microsoft, Apple. I look at that and I think big tech isn't overvalued.
They're value stocks. Yeah, they're valued. Yeah.
Yes, they almost are.
Yeah, GARP, the old GARP term. You don't hear that much anymore.
We just brought it back.
And so what about as you look out over the next 5 to 10 years, do you see, I mean, obviously I'm a venture capitalist. We see a massive market opportunity for tech. I mean, we're funding companies all over the world that are tapping into the 2 billion people that don't have a bank account, and the billions of people that don't have healthcare, and the billions of people that don't have streaming entertainment. But how do you think about that? And let's assume we're going to go through some economic cycles. What about the demand side and the market opportunity side for these companies? And maybe even kind of the next layer, beyond the Facebook, Amazon, Google's, the next generation of maybe, 5, 10, $15 billion companies that are trying to become the next Amazon, Facebook, or Google.
Yeah. So, near term in the next 12 to 18 months, I think there's 2 major problems, real problems in the world today, business today. I'm sorry. One is all these shipocalypse, these supply constraints. So there's an enormous opportunity if somebody can figure out a logistics solution for that. That's not, I know what the problem is. And if there's a big problem, that means there's a lot of value in solving it. The second one is marketing. So with these changes in Apple privacy, I mean, this has dramatically impacted a lot of small businesses and the large advertising platforms. Bad for Snap, bad for Facebook, but it's also challenging for the millions of small businesses that used Facebook and had a pretty good return on their advertising spend. So somebody who can solve that in the next 6 to 12 months, these are both kind of 12-month problems, but I know what the problems are. I just know that whoever can solve those 2 is probably going to be worth a lot more value, going to be much more valuable in 12 months than they are today. And then longer term, I'm intrigued by things, and I don't know where you come out on this metaverse idea. I mean, I don't know whether there really is there. But that's a lot of money that's being spent on it, 10 billion a year, by a company that's had a very successful track record of product innovation. I'm talking about Facebook. And there are other companies that could be in there. I don't know if it's the hardware, the software, the network. I don't know which of those angles is the best way to take at it. But the idea that we could do more, like I sometimes refer to it as GVR, group virtual reality. If we can somehow use virtual reality to better connect with people, but professionally, commercially, socially, I would think that that's something that could be a really interesting end market. So that you talk about 5 years, that's probably 5 to 10 years.
Yeah,
I'm very intrigued by that. And then payments. I don't focus as much on payments, but I look for something that's broken that could certainly use improvements. And cash could use improvements, and credit card payments could use improvements. Like there should be room for a lot of really interesting innovation in that space. My guess is, Jeff, you're all over it.
Yeah, my largest personal holding is my I call it my Mount Rushmore of payments, which is Adyen, PayPal, and Square.
That's
so I own all 3, and
you're hedged.
I added more, and I do think the metaverse thing is real. I think that it's hard to describe. It's a little bit like cloud 10 years ago, right? When IBM was talking about the cloud, and everybody was like, not sure that's the cloud. I think what it is going to look like is, when I look at what my son does today, plays Roblox, play Minecraft, He's paying for things virtually. He's collecting skins and art virtually. He's chatting virtually on Discord. That is the metaverse. Now, how that evolves into the more mainstream public, adult population, he's going to be an adult in 8 years. So I think some of this will happen naturally as the digital generation, the folks that have grown up in that. I mean, he's not going to think twice about paying for things with his phone or, I was driving my daughter to school the other day and I said, do you have anything to eat before school? She says, no. She said, I'll just DoorDash something. I mean, for her, that was like, now we had to have a conversation about budgeting, but it was just such and I said, oh, do they allow that at school? She said, oh yeah, they have a whole area set up. They have a whole area set up for DoorDash to deliver.
Wow.
So I think the younger generation, the folks that are in their, teens and 20s, the spending power in that generation is way bigger than it was when we were kids, because we didn't have digital ordering for anything, right? We had to go to our parents and say, hey, I'd like to, go to, go to the Best Buy and buy something. They can just digitally order if they've got the budget and the resources. So to me, that's, and I think it's a smart bet by Zuckerberg. I mean, he's basically saying, none of us quite know what that is, but we have a VR asset that likely will play a role in it. So we better go build around it. It's kind of like what Bezos did with AWS, right?
Yes.
He said it back in 05, 06, I've got this infrastructure that we use to run our retail business. What if I pointed at that other, universe? And everybody thought, oh, this is kind of a, what is this? It's not that interesting. And then when they started to release the numbers, people were like, holy crap, this is a huge business. And today, AWS is probably worth $1 trillion on its own. So that's the analogy I've given internally is, I think Zuckerberg is basically saying, I've got this VR asset. I've got, 1 billion people around the world on my platform as it is. Why wouldn't I want to go play in this next generation economy that's going to happen? I think his biggest challenge, and I'm sure have talked about this a ton, is I'm just not sure the government's going to let him acquire anything in that space. I'm sure he'd love to own Roblox or would have loved to have bought Minecraft or something, but that's going to be a challenge for Facebook.
But Jeff, I think the way you set it up is right, which is, older Robloxers or the Roblox generation, like they are gonna when they start becoming adults, they're gonna think about things a lot differently than you and I did.
100%.
Or have, and that's probably the single best. You just probably mentioned the single best reason why there will be a metaverse.
And I think it also intersects with crypto. So if you look at this whole NFT, the rise of NFTs in the crypto world, I mean, my son owns NFTs, right? He owns these skins and little pieces of art that he uses in Roblox. That concept it's really hard for my parents to understand. For him, it's like, oh yeah, of course I'd love to own my own thing that I can use in a game or use in some virtual universe that I'm playing in. So I just think it's going to be a very native experience for that generation. And I think it's a smart bet. Like you said, founder-led companies, right? If you read the Everything Store, one of the things I love about it is they talk about a bunch of things that didn't go right. They did AWS and they did Prime. They did Kindle, which, yeah, it's important, but like that was a huge bet at the time for Amazon. And a lot of analysts thought, why are you building a digital book? But making those forward bets and being able to spend hundreds of millions or billions of dollars on them is a really unique component of founder-led companies.
Yeah.
How about
Amazon's a great example of that. I think DoorDash is probably a great example of that.
I was going to ask you. So give me some other newly public names that you're excited about that you think have that same kind of DNA. DoorDash is an incredible one. I think Tony's an incredible founder.
Well, I'm going to, not necessarily that new, but in the last couple of years, I really like Spotify. I've liked that for a while. I think that stock is now, I'm trying to get out of the day-to-day, but that stock I think is finally breaking out. I think if you like Netflix, I think the end market for a name like Spotify, although the business model isn't as attractive, the end market can be almost as big. And I think you got a founder-led company with a really compelling value proposition. And hey, this is something as any consumer can, decide for themselves whether they think Spotify is worth, $10 a month, and would it be worth 11 or 12 to you? So that's the way they're starting to exercise pricing power. I like that one. Uber, you mentioned DoorDash. Uber is one of my favorite names. Now that's not founder led, so there's a little bit of a dig.
Yeah.
I'm a big fan of Dara Khosrowshahi because one of those other things I look for in management teams, which is that the stuff's going to hit the fan from time to time. Things are going to go badly. Great financial crisis was a great example. And I remember Dara specifically saying, right, he was the first tech executive who said it's a dog's breakfast out there. And that always stuck with me, like that he got street cred with me for saying that. So then when he came to Uber, I literally wrote, I think it's great to have Dara Dog's Breakfast Khosrowshahi as head of Uber, because there's a lot of stuff they're going to have to shovel out. And he did, and to his credit. So I do like Uber as a stock. If I go down cap a little bit, we also like Match as a stock, although that's been around for a while. As subscription businesses, we generally like. There's a series of new IPOs. There's one in the recruitment space that I like, ZipRecruiter, that I don't think the public market has really figured out yet. So I think they've got a very innovative AI-based approach to recruiting, matching up job seekers and potential employers. So that's another name I would throw out there. Airbnb is a recent IPO, although it's been around for a while. There's I love those founder-led companies, super focus on product innovation. Like one of the other tags from the book is if it doesn't, it don't mean a thing if it ain't got that product swing. And i.e., the product development is consumer-led companies. It's all about product development. And Airbnb's done a phenomenal job of innovating for both consumers and for hosts in a large category, highly disruptive company, great long-term business model. So, and that's another name I like.
Yeah, and I would add, we're lucky to be an investor in Airbnb. The other thing I think is a moat for Airbnb that a lot of people don't understand is the product innovation, right? Their understanding of what hosts and consumers want is so much deeper than, for example, VRBO. That over time, I think Brian and the team will innovate in ways, even acquiring Hotel Tonight was a brilliant move on their part, in my opinion. We were an investor in Hotel Tonight, but the experiences business is now a meaningful contributor to the top line. I don't know. I love businesses like that are founder led and have a creative vision that other people don't quite understand. Because if you can own those companies for a long time, when that vision comes into play, that's when it gets interesting. So, well, look, man, this has been awesome. One more time, give us the book.
Nothing but net, and it's out November 9th on your favorite online, bookseller, whatever that might be. I really enjoyed the process, and hopefully there's some fun lessons in there. I throw. You can read about all the mistakes I made, and then some of the things I got right. But I really try to look back and try to come up with useful ways people can look at tech markets, growth stocks, and make money, and reasonably. And anyway, so hopefully it's helpful. I really enjoyed having time with you today, Jeff.
I'm going to have to see if I can find a way to get an autographed copy. So
we'll make
one of the first to order. Yeah. All right, Mark. Thanks, man. Appreciate it.
See you, buddy.
Take care.